When I started investing, I made some really costly mistakes. And they not only cost me in terms of my capital, they also cost me in terms of the time it took my money to grow. And even if you've been investing for a long time, you might find yourself making some of these mistakes every now and then, which could be costing you a lot of money. And so in this video, I am sharing 9 mistakes that I see investors make in order to help you avoid them and successfully build your wealth regardless of market conditions. And number 8 is a big one and you won't want to miss it, so keep watching until the end. If you're new here, hello and welcome. My name is Jumoke and I am an investment banker turned early retiree. On this channel, I share some of the strategies that I applied to manage millions of dollars for some of my ultra high net worth clients. I also talk about personal finance, investing, wealth creation, as well as self-improvement. If that sounds interesting to you, do not forget to hit the subscribe button. If you aren't already subscribed, click on the notification bell so you don't miss any new videos. Let's dive right in. The first mistake that I see a lot of investors make is having itchy fingers, i.e. lack of patience. If you've ever felt that itch to check your portfolio every hour, or perhaps you've panicked when your stocks have dipped, trust me, you are not alone. You'll often hear investment professionals say that investing requires patient capital. And boy, are they right. And this is also why it is never a good idea to invest your last resort. You need to be very clear and intentional about what monies are for funding your day-to-day living and what is there for long-term investing. It is so tempting to want instant results. You invest and you expect those green arrows to follow. But the truth is, real wealth building in the financial markets is a marathon, it's not a sprint. If you are constantly refreshing stock prices or selling at the first sign of red, you are sabotaging the one thing that your wealth needs to grow, and that is time. And remember, some of the greatest investors in history made their money by waiting because they understood that markets will go up and down. It's the long-term trajectory that matters. And so if you ever feel your patience slipping, and believe me, at some point you will, take a deep breath. Remind yourself of why you started investing in the first place. If you've had a solid strategy from the start, stick to your strategy. And remember, patience isn't just a virtue in life, it's a superpower in investing. Believe me, I learned the hard way. Have you ever heard people saying investing is for the rich? By far the most common mistake I see people make is not investing at all. Investing is not for the rich, but yes, it is for those who have disposable income. That's not the same as being rich. And some people hold cash in their bank accounts their entire life and they never invest. This is a huge mistake. And I'm about to give you some scary but necessary data to explain why this is a bad idea. $1,000 in 1970 is equivalent to $8,242 today. That's an increase of $7,242 over 55 years. And that means $1 million in 1970 is equivalent to $8,242,000 today. And the dollar has had an average inflation rate of 3.91% per year between 1970 and today, producing a cumulative increase of 724%. And this means that prices today are 8 times as high as they were in the 1970s. And this is according to the Bureau of Labor Statistics Consumer Price Index. Put another way, a dollar can only buy 12% of what it could in 1970. And so what this means is that the real value of a dollar has declined over time, which means that a dollar can buy fewer and fewer things as time goes on. And just look at this graph, which shows you how inflation has eroded the value of a dollar over time. It shows that $1,000 in the 1970s is now worth only about $114 today. And what this astonishingly means as well is that the dollar has lost 60% of its value in just my lifetime. Imagine things being 2 or 3 times more expensive than they are today when you're in your 70s or 80s. And even if you keep your money in a savings account, you will need interest rates to continuously outpace or beat inflation for you to see any sort of real growth. Otherwise, you are losing money and you're falling behind. For most people, their income is never going to make them rich, and this is just a sad reality. but investing may give them a chance. And look, I get it. Investing can be intimidating. All those graphs, those numbers, the jargon, it's a lot. And I know that money in the bank gives you a sense of security and control like nothing else can. And maybe you are worried about losing money, or you feel like you don't know enough yet, or maybe you're just waiting for the perfect time to start. But here's the truth. There is never a perfect time. Every great investor you've heard of had a moment where they just had to take the first step despite the fear. And the emotional experience of risking your hard-earned money is probably never going to go away, even when markets are rising or booming, and even more scary when they're falling. But the options are letting inflation slowly eat at your hard-earned money like termites on wood, or putting up with the fear of financial markets and at least giving your money a chance to grow. And while every investor's dream is to start investing during a recession or a market downturn, these are possibly a once-in-a-lifetime opportunity to buy stocks on sale. They unfortunately do not come around as often. Since the 1950s, there have been between 13 to 15 market crashes in the US. And if you are waiting for the markets to crash, or you're waiting for a recession, that's less than 5 opportunities in the average working life to get started. And then, of course, you need time to allow your positions, your stocks, or your portfolio actually grow. Saving in your bank account isn't enough. You have to save and then invest in order to give yourself a better chance of success. The third mistake that I see a lot of new investors make is not having a safety net, i.e. not having an emergency fund before you start investing. Before you open a brokerage account and hit that buy button, it's really important to ensure that you have a cash reserve that you can dip into when you're hit with an emergency or unexpected life event. You lose your job, or you have a health emergency that isn't covered by your insurance or your national health service, for example. We cannot always foresee events in life. And the last thing you want to do is to be forced to sell your investments. And especially during the worst possible time, during a market crash, for example. And this is why an emergency fund is so important. There's a very interesting and eye-opening report on Motley Fool, which analyzes data from the US Federal Reserve on US savers. The report found that only 54% of Americans can cover 3 months worth of expenses from their savings, while only 45% of Americans can afford to fund a $400 expense from their checking account or their savings. And it goes further to break the savings balances by race as well as age. And if you're interested in reading the article, I will link it below. And I get it, saving for an emergency fund mightn't be the most exciting thing to do versus investing in the latest growth stock or perhaps the latest crypto trend. But this is your safety net, so please do not take it lightly, especially in light of what is going on today and just how difficult things are. The financial markets can be extremely volatile. And so what that means is that your $500 or $1,000 invested today could go down to $300 in 2 months and then go back up in 6 months. And if you've been investing for a while, you'll notice that markets tend to be quite choppy and volatile in the short term, but they do generally trend upwards in the long term. Have a look at what happened with the S&P 500 over the last 6 months, especially when the tariff debacle happened in April 2025. And then zoom out 5 years or more to see the upwards trend. If you're wondering how much you should have in your emergency fund, a good consensus on what amount to have is enough to cover 3 months worth of expenses. But if that seems like quite a stretch for you, you can always start with $1,000 or pounds and build from there. The fourth mistake that I see new investors make is not understanding what their risk tolerance is. One of the most important questions that any financial advisor will try to answer and understand when they're dealing with a new client is, what is my client's willingness and ability to take risk? Your willingness to take risk is more of an emotional or cognitive factor, but your ability to take risk is based on how deep your pockets are, amongst other important factors. Your risk tolerance will inevitably change over your lifetime. And this is well explained by something called the investor life cycle. When you are younger, you have more time, more youth, and more strength to build your wealth as well as recoup any losses that might come from financial mistakes or from investing. But the older you become, with changing responsibilities like having a family, for example, especially approaching retirement, the less time you have to recoup any financial losses when they occur. Just take a look at this data point from FINRA, which shows the percentage of younger people interested and invested in crypto versus older people. And this is also why when you hear information online about stocks or investing, you need to think about your personal situation and circumstances. Someone with $1 million of net worth can maybe afford to lose $10,000 on one particular stock. That's 1% of their net worth. But that same number is 10% of the net worth of someone with $100,000. The question is, can they really afford to lose that much on one investment? The fifth common mistake that I see investors making, and this follows on from the fourth mistake, is investing based on trendy stocks or meme stocks that you've heard online or perhaps your family or friends have told you about. Now, here's a true story. In 2021, Elon Musk said to his followers, use Signal, and this was an instant messaging app. And you'll never guess what happened next. Some of his followers mistook Signal for a completely unrelated company, Signal Advance, and almost immediately, the stock saw a huge rise in its price, and 2 days later, it crashed. So you receive a hot stock tip from your friends, or perhaps you've seen an influencer online hyping the next 10x crypto. It's all very tempting because nobody wants to miss out. But here's the thing. Investing is risky, and even more risky investing based on a hype, as opposed to a well-researched stock or asset. In fact, a 2023 study by Harvard Business School showed that social media exacerbates behavioral biases. It induces trading more than any traditional attention-grabbing factors, and this in itself is detrimental to investor performance. They also found that social media investors underperformed in other asset classes besides stocks. And the sad reality is that sometimes those who profit the most from these hot tips are the ones selling it to you. They might have gotten in early whilst you're left holding the bag when the hype fades. So a much better approach is to build your own investing strategy. Understand the companies that you're invested in. And if you don't want to do all of that research, or you don't have enough time or capacity, investing via index stocks or ETFs is one way to go. You need to know your risk tolerance and also have a long-term investment plan. And I made a detailed beginner-friendly video on 10 investment options that you could make with $1,000, and I will link it here. And so remember, the best investment options come from knowledge and not whispers in a group chat. The sixth investment mistake that I see new investors make is over-trading. Studies have shown that frequent traders often underperform long-term investors. A landmark study from the University of California found that most active traders underperformed the overall market by about 6.5% annually after accounting for fees and poor timing. Now, it is tempting to consistently buy and sell in hopes to catch every single market move. But here's the thing. All trades come at a cost. And whilst trading and investing are similar in that they are aimed at profits and growing your money, they are also quite different. Trading is faster, more speculative and riskier, i.e. buying and selling stocks for short-term gains, while investing is slower but safer because you are buying and holding good quality investments for the longer term. Now, for example, you can easily trade a dead stock due to minute-by-minute swings, and you can actually make profits, especially if the stock is experiencing something called a dead cat bounce, but you would never want to invest in a stock that is headed to zero. And those trading fees, whilst they might seem small, can add up very quickly. So for example, in the UK, certain trading platforms can cost up to £12 per trade. You then also have to pay stamp duty on your trades and also consider FX consequences if you're investing in international stocks. That's a lot of costs. And even when the platforms you use claim to have zero commissions, there can still be hidden costs like spreads, slippage, as well as short-term capital gains taxes. And over time, these can easily eat into your returns, making a potentially good year an average one. The seventh mistake that I see new investors make is not diversifying appropriately. In the game of investing, Diversification is not only your friend, it is one of the easiest things to do. And it's very easy to fall in love with one stock or one sector, for example, Apple or the tech sector. But putting all your eggs in one basket is extremely risky because no matter how much you believe in a single company, even the best businesses can experience unexpected challenges. Now, here's a quick reality check. Studies have shown that investors who concentrated their portfolios into a few stocks were way more likely to underperform the markets over a decade. Now, I know some of you might be thinking that Warren Buffett said diversification is for those who don't know what they're doing. And he's right, if you're Warren Buffett. And he's stepped away from his role now after 55 years. But before he did, he had resources, he had time, and he had insights to deeply understand the companies that he was invested in. And for most of us, diversification isn't a sign of weakness. It's a smart way to spread your risk and capture more opportunities. And what's more is that Warren Buffett was actually invested in several businesses and companies, which means he was diversified. I believe what he was referring to when he made that statement is randomly selecting 100 stocks, holding your breath, and hoping that one of them takes off. So if you are building your portfolio, remember, it's not about choosing 50 random stocks, but having a well-balanced mix that can weather markets' ups and downs. And you can spread your investments across stocks, bonds, real estate, cash. A little variety goes a long way. The eighth investment mistake, and this is a big one, that I see a lot of new investors make is not factoring in tax consequences of their investments. Now, most people don't realize this, but taxes are their single largest expense. They'll spend more on taxes than anything else in their lifetime if they are law-abiding citizens. And I'm not just talking about income taxes. Think about all the things that you have to pay taxes on. The average person in a developed country spends between 25 to 30% of their life working to pay taxes. That essentially means that more than 2 hours of every working day is dedicated to feeding your government. 3 to 4 months every year are spent solely working to pay your taxes. Now think about it. That is about 13 years of your work life working just to pay taxes. Now here's a quick example of someone who lives in New York and earns £50,000 a year. According to the latest tax figures, you will be taxed $10,631. That means that your net pay will be $39,369 per year. It means that your average tax rate is 21.3% and your marginal tax rate is 26.6%. So for example, an increase of $100 will mean that you're paying taxes of $26.6. And the situation in the UK isn't any better. According to a 2024 Morningstar report, taxes can reduce your investment returns by up to 1 to 2% annually if you're not careful. And over a few decades, that can actually add up to thousands or tens of thousands or even hundreds of thousands in lost potential gains. Typically, when you invest, you have to pay taxes on your dividends and any interest payments, and you also have to pay capital gains taxes on any profits you make when you sell your investments. So for example, short-term capital gains, which means that you are holding that investment for less than a year, are taxed at ordinary income tax rates, which can be as high as 37% in the US and up to 45% in the UK, depending on your tax bracket. And in contrast, long-term capital gains can be as low as 0 to 20%. That is a lot of money gone on taxes. Now, it's very easy to get caught up in the thrill of buying low and selling high. But if you aren't thinking about the impact of taxes, you are potentially leaving money on the table. So what can you do to legally avoid massive tax bills? Well, one of the best ways to do this is to use the right investing account. Make sure you are aware of and maxing out your tax-advantaged accounts, such as your ISAs if you're in the UK, or your Roth IRA, your 401k, which are all tax-efficient wrappers. And when you do this, any growth or income in such accounts are tax-shielded, which means you could be saving yourself thousands in taxes. Life is busy, and the financial world can be overwhelming. But here's the thing. Markets, as well as laws, are constantly evolving, and companies do not exist in a vacuum. And ignoring this reality can sadly lead to lost opportunities or even worse, costly mistakes. And this is money that you've worked extremely hard for, and why it's also very important to think about your personal approach to investing. Do you want to buy stocks or bonds and regularly monitor these companies, or do you want to just set it and forget it by using index funds or ETFs, as well as robo-advisors? You don't have to be a market expert, but if you want to become a better investor, make it a habit to learn. And the way you can do that is by following reliable financial news resources. You can read books, you can listen to podcasts, or even join investing communities. And I will leave you with this. Remember, every great investor was first a learner. So that's it for my top 9 mistakes that new investors make. I certainly am guilty of making some of these in the past, and so I'm speaking from experience. And if you are a complete beginner at investing and you're not quite sure where to start, I posted a video on 10 beginner-friendly investments that you could make with $1,000 to get you started. And you can watch this next. That's it, my dear friends. I will see you in the next one. Bye for now.